The latest data rising for the second straight month. The headline number, a gain of 0.4% in September, 3.7% from a year ago, higher than the street expected. And the core, which excludes food and energy, is up by 0.3%, in line with expectations. Now, many analysts are pointing to shelter costs being the main driver, accounting for around half the rise in CPI. And by the way, those were shelter away from home costs, a lot of them, hotels. Joining us now, Michael Darda, Roth MKM chief economist and macro strategist as well. Mike, it's great to see you. Man, that's a lot of numbers I threw at people. Give me the bottom line here. Is inflation moderating enough for the Fed to take a pause or be done after its next meeting?
Thanks for having me on, Julie. I think inflation has come off the boil enough for the Fed to stay on pause here and assess the macro conditions. Keep in mind that inflation's a lagging indicator. Inflation will tend to lag the business cycle. So if we just have the Fed jamming the policy rates higher and higher and higher until inflation goes all the way back down to their target, we'll be in a very, very deep and protracted recession. And the Fed knows that. And so they're trying to gauge the state of the economy. But this set of numbers does not help. You mentioned the super core inflation numbers. So I'm afraid Jay Powell has kind of painted himself into a box a bit by focusing on that specific set of numbers, which was not good this morning, up 0.6, and that follows a 0.4 rise in August. Now, the good news is the 3 or 4 months before that looked really good. So I think we should have some patience with these numbers because they can be volatile and they do lag the business cycle. But definitely the higher than expected inflation data on the core side is going to reinforce this idea of higher for longer. And that's the main reason that bond yields were shooting up over the course of the last 4 or 5 months.
Mike, it is great to see you and your very handsome dog there in the background, Klaus, just chilling. We're very pro-dog here on Yahoo Finance, Mike, so it's great to see the two of you. I just wanted to know, Mike, one question I had for you as an economist was, can the Fed get that inflation back down to their 2% target when the labor market, Mike, remains this sturdy?
Yeah, great question. So many of the Fed members are pretty worried about the tight labor market. They sort of are still operating with this Phillips curve framework in their head. And so, they're kind of on edge in terms of whether they should continue to tighten more or to be patient. But what I would say is the labor market's very, very tight, but the unemployment rate has been going sideways now for over a year. In fact, there's a subtle rise going on. Year over year, the unemployment rate is up actually 0.3, and it doesn't sound like a lot, but keep in mind that when you go up 0.5 from year earlier periods, that's always marked the beginning of a recession in post-war history. So, the labor market is tight, but the flat to slightly higher unemployment rate would suggest the economy really is just kind of meandering at trend. People are really excited about Q3 and the Atlanta Fed number as this huge, almost 5% GDP figure, but I don't think it's likely to be sustained if we do see it at all.
So, Mike, that's your economist hat. Let's get you to put on the strategist hat as well, because in some of your recent notes, you talk about the risk premium in the market. Now, everybody's been talking about the risk premium in bonds lately, but you're also talking about the equity risk premium here. And what you seem to be saying, if I'm reading you correctly, is that the market is not priced right now in terms of some of the risks that you're talking about from an economic perspective.
Yeah, that's exactly right. So we've had this big surge in bond yields this year and, a fairly minimal pullback in equity prices. And so the result is if we look at the earnings yield on stocks, which is just the inverse of the PE, relative to the 10-year Treasury yield, equities actually have not become cheaper relative to bonds. They've become more expensive because bond yields have gone up so much relative to an equity market that's not much off of the highs of the year. And if you go back, we're talking about, real rates and inflation expectations. Real rates on the 10-year Treasury are up above 2%. And if you have to really go back to the 06 to 2006 to 2007 period to see a sustained period where real rates were above 2%. The forward PE on the S&P 500 during that period was actually around 15, and we're at 18 now. And so I think we have a problem with the equity market valuations if the 10-year yield stays in current ranges or pushes higher. If it pulls back, it was earlier this week until this inflation report, I think that helps, but it doesn't really help if the equity market's rallying at the same time. So you really need the bond market to outperform the equity market for stocks to become cheaper relative to bonds. And I think ultimately that's what's going to happen as we move through the end of the cycle.
And Mike, just given that outlook then, as you look at the equity market here, are there sectors that you're telling clients you find more attractive?
Yeah, absolutely. So we'd be a little bit wary on what has led the market this year. So the Infotech Index has been a star performer, incredible. Obviously, there's a lot of enthusiasm over AI, and I think we all hope that that plays out and lifts productivity. But at a 25 forward multiple, that's a pretty steep forward multiple, especially relative to where the forward multiples were in Infotech the last time the rate structure was this high. I would look at a sector that maybe is more defensive, that's also sold off really hard over the course of the last year plus. And that sector, I think, is utilities. Not super exciting, but we almost had a 30% collapse in the utility sector as rates have surged. And in our work, that sector now is on the top of our rankings. And it's also a defensive play. So if you're worried about the end of the business cycle, the Fed tipping us into recession with higher for longer, or threatedly if they start hiking rates again, I think that area is interesting here.
That combined, the liking of the utilities combined with what you were just saying about rates, just real quickly here, do you think we've seen the ceiling in the 10-year and in the 30-year in yields?
Yeah. Well, maybe I'm the wrong person to ask because I thought we already did. So admittedly, we've gone up a bit more than I expected. I was pretty bearish on the treasuries in 21 and in 22 for most of 22, but once we got materially up above 4, I was kind of thinking, if inflation's peaking, maybe we're seeing the top in yield. So we made a run almost at 5% this past week. But I don't think that those yields are going to be sustainable. I mean, ultimately, you do have an economy that is decelerating on the back of the tightening the Fed's already done, and there are lags. And so as those lags unfold, I think we're looking at weaker economic conditions. Inflation eventually will come down. And so I think that the bond yields will ultimately be headed lower from current levels. And the way I would play that would be through the utilities rather than a sector that's carrying really steep valuations now, which really needs everything to go right to sustain those valuations. So I would look at more defensive categories that have been hurt by the rate shock.
All right, Michael Darda, Roth, MKM, Chief Economist and Macro Strategist, and Klaus, we thank you both for your time today.
Thank you, guys.